In this week's market update, shares surge on hopes for US tax reform, Brexit fears hit UK growth and Theresa May's prospects, and Spain in focus as Catalonia calls for independence. Stock markets have found a new reason to push further into record territory. Tax reform proposals from the Trump administration gave Wall Street a boost last week and will most likely be the main market focus for the rest of the year. Hopes for tax cuts were one of the main drivers of US markets in the wake of Donald Trump's election last November. So the revival of hopes for reforms has rekindled the bullish case for shares. In particular, smaller companies, which pay more tax proportionately than their larger peers, have been outperforming. The S&P 500 rose by 0.6% last week and by 1.8% for September as a whole. Over the third quarter from July to September, it pushed ahead by 3.8%. That was the 8th quarterly rise on the trot and only the 5th time a run of this length has been achieved since data began to be collected in 1929. Both Nasdaq and the Russell 2000 Smaller Company Index also hit new records. Other beneficiaries of the tax reform story have been the dollar and bond yields, both of which rise as prospects for economic growth improve. The dollar rose in September for the first time over a calendar month since February, and it now stands above its 50-day moving average. That shows that momentum is back on the dollar's side. And the yield on 10-year treasuries is now back at the top end of a range between 2% and 2.4%, which has been in place since the spring. The Trump tax reforms are potentially a turning point for the market, but there remains plenty of uncertainty about whether they will actually get through Congress. The White House's proposal is really only an opening bid, and there'll be months of debate before anything actually passes into law. But assuming it does, this could be the trigger for the final push of the current long bull market. A corporate tax cut increases the proportion of profits that go to shareholders, and so by definition it pushes share prices higher. Any moves to help repatriate profits held overseas by companies would have the same effect, because much of the cash brought back to America would likely be passed on to shareholders through higher dividends or share buybacks. The impact on the dollar also reflects the likelihood that fiscal stimulus would allow the Federal Reserve to push interest rates higher. Last week, the odds of a December rate hike continued to increase, and it now looks very likely that another quarter-point hike will be achieved this year, and then 2 or probably 3 more in 2018. The impact this has on overseas markets, especially emerging markets, remains to be seen. In theory, though, a stronger dollar and higher interest rates makes it more favourable for investors to park money in the US, and this could reduce the attraction of emerging markets. Elsewhere in the US this week, attention has turned to how long Janet Yellen will remain at the head of the Federal Reserve. Her term is due to expire next spring, and President Trump has been talking with Kevin Warsh, a former Fed governor and a leading candidate for the job. Mrs. Yellen, meanwhile, said she had not met the president since early this year. The significance of a Warsh appointment is the fact that he has been highly critical of current Fed policy. He's a skeptic about quantitative easing and a supporter of the president's fiscal reforms. A Fed led by Mr. Warsh would probably be more hawkish, with interest rates probably rising faster and further than under Mrs. Yellen. The case for higher rates will come into focus at the end of this week, when non-farm payrolls data for September is announced. Although the US economy has been creating plenty of jobs, so far it's not had much of an impact on wage growth, which remains weak and has allowed the Fed to be more cautious than might otherwise be the case with unemployment at such a low level. On this side of the pond, the party conference season has moved on to the governing Conservative Party, with market participants mostly concerned about the impact of a fragile leadership on the pound. Last year's conference saw the pound fall by 4% after the Prime Minister and Home Secretary made speeches that suggested the government was leading the country down a path towards a hard Brexit. This year should be easier on sterling after a more constructive approach to the Brexit talks was flagged by the Prime Minister's recent speech in Florence, and against a backdrop of an increasingly hawkish Bank of England. It now looks increasingly likely that UK interest rates will also rise before the end of the year. The bigger challenge, though, for the Prime Minister is survival in her job, as her rivals look to be on manoeuvres ahead of a potential leadership challenge. The pound has risen by about 10% since the spring. This week will determine whether it holds on to those gains or retreats again. The other potential negative for the pound is the growing evidence that the post-Brexit growth honeymoon is now well and truly over. Having been at the top of the G7 league table at the time of the EU referendum, Britain is now posting the weakest growth among the world's leading industrialised nations. The Office for National Statistics last week revised down its estimate for quarter two growth from 1.7% to 1.5%. Meanwhile, house prices in London fell for the first time in 8 years in the third quarter. In Europe, the big focus over the weekend was Catalonia's controversial independence referendum, which was ruled illegal by the central government in Madrid and prompted widespread violence as around half the 5 million eligible voters in the region fought past police and the military to reach polling stations. With around 90% of those who voted, 40% of the total, calling for independence, it's likely that Catalonia's president will unilaterally declare independence sometime this week. Such a declaration would have no legal force and would probably not be backed by the international community, but it would throw Spain into a huge constitutional crisis. The market reaction yesterday was negative but relatively muted. The IBEX 35 benchmark index in Madrid fell as much as 1.3% against the trend for European stocks more broadly. The yield on Spanish government bonds rose by 8 basis points as investors demanded more reward for the higher risks they now believe they're taking by lending to the Spanish government. Meanwhile, in a year of elections, Japan's forthcoming snap poll has become a lot more interesting than Prime Minister Shinzo Abe probably intended, after the popular Tokyo governor Yuriko Koike launched a new anti-establishment party, it's dubbed the Party of Hope, which bears more than a passing resemblance to Emmanuel Macron's En Marche party that swept to power in the spring in France. She has now emerged as the main rival to Abe and would be Japan's first female prime minister. A former television presenter, she represents a massive challenge to the conservative male order which has long dominated Japanese politics. It's not quite what Abe expected when he called a snap election to capitalise on the fast improving fortunes of the Japanese economy. Just this week, evidence emerged that business conditions in Japan are at their strongest in a decade, with the Tankan index hitting its highest level since 2007. Japan's unemployment rate is currently down to 2.8%. That's its lowest since the 1990s, causing labour shortages in some industries and pushing Japan further away from the deflationary environment which has blighted the economy for a generation. In other key markets, finally, oil continues on the front foot as strong demand and threats to supplies, especially in Iraqi Kurdistan, push the price closer to $60 a barrel. Last week's big oil conference in Asia saw muted confidence from the oil industry. While the outlook for the oil price is brighter than at any point since the fall from over $100 a barrel in 2014, US shale remains the wild card. The fear is that an ever more productive shale industry will take advantage of the recent rally to up its output even further, putting a cap on the cost of crude at around the current level. Gold, meanwhile, has lost its lustre recently as geopolitical worries have fallen off the radar. Gold has tended to rise as anxiety about North Korea's nuclear program has intensified and fallen back when things have gone quiet again.